This week on Simply Des Moines Weekly Market Update, we're going to talk about the Federal Reserve rate and what that means to real estate. So let's jump right in. Hey there, Les Solgrove with Simply Des Moines Real Estate and Via Realtors. This week's week 24 of the Des Moines and Central Iowa real estate market. And before we get into this week's topic, which is talking about the Federal Reserve and how that's all affecting real estate, let's take a quick look here at one slide here, and that's the week 24 dashboard. And why this is important this week is that we're solidly now in a buyer's market in both new homes and new condo townhomes. And we've also switched back to where we have more existing homes on the market than we have new construction homes. So we have more existing homes on the market than we have new construction. And I think this is kind of the direction we're heading. Months of inventory is creeping up in all categories, but very, very, very fast still in the existing home market here. So this week, like I said, I sat down on Friday with David Bell from Gershman Mortgage, and Dave and I are good friends, and I asked him to jump on with a timely topic of, the Federal Reserve raised the prime interest rate for borrower lending, which is predominantly your consumer lending, and ask him to kind of explain it better than what I'm doing right now. And so let's just kind of jump right into that interview. Hey there, I'm changing the show up a little bit this week. Today I've invited Dave Bell from Gershman Mortgage to join me so that we can have a talk all about everything mortgagee. Is that a word you've ever heard before?
I hear it so often. I'm just a mortgagee expert. Yeah,
mortgagee expert. So here's the catch question of the day. What's new in the mortgage lending field right now? Anything happening?
What is old is new again, Wes. Let's face it, education. The minute people start getting worried, you need to shine the lights on the shadowed areas and make sure they understand what the heck is going on. Because when some people see the disadvantage, there's actually an advantage. When some see negatives, they are pluses. So now's the time to really understand what's going on and make informed decisions as opposed to just going off your gut.
Yeah, that's so true. So true. So, and I don't know if you notice here, but we're both wearing red. I wear red on Fridays as much as possible for the Remember Everybody Deployed, so I appreciate your service. And about a week ago, you were promoted to Senior Master Sergeant with the Air Guard. Is that correct? Do I have the right?
Yes, sir. You were in attendance to the ceremony. Thank you so much for joining us. It was awesome. My chief, originally I said, hey, I want to keep it small. I want to maybe just the chief, the first sergeant, the commander, myself. And she's like, oh, hell no. You're making Senior Master Sergeant. That's E8, top 2% of the military and the enlisted rank structure gets that. So she's like, let's do this big. And we did. So you made it. Thank you for coming. I really appreciate it.
Well, congratulations and well-deserved. And I feel safer every night when I go to bed when I think about you out there. So I'm going to start off here, back to our question and answers here. I'm going to start off here with a little graphic, and it's I'm going to talk quickly about this past Wednesday of this last week. The Federal Reserve issued the most aggressive rate hike since 1994. And, you talk about the sky is falling. The media is out there just trying to scare the heck out of everybody. So what I want you to do is kind of be the sounding board of reason here and bring us back down to earth. What exactly is the Federal Reserve interest rate? And how does it really affect the U.S. economy?
Yeah, so this is the money that the banks are able to lend to each other at a particular interest rate. And so really, this is an aggressive move. What they're doing is you've got to think back. And I really try to make sure people understand the historical context of what's going on. What happened in May of 2020 when COVID was hitting the United States in March of 2020? The American government did not really know what was going to happen, especially with government loans. They really thought government loans were going to go into foreclosure in mass droves. And so they allowed for forbearances to take place, but they're really concerned. In fact, Les, there was like a 2-week period there where as a lender, I could not get an interest rate for an FHA or a VA loan. It was a really odd period of time. And then that Sunday, during the week of May, when the Fed basically cut rates to zero, and they said, hey, we're going to not only that was one piece of the equation. Bigger piece of the equation was the quantitative easing that they did. They pumped so much money. They started printing so much money into the market to try to drive our economy, because they're very concerned if the housing market goes, if the economy goes, because let's face it, we had schools, we had so many businesses, we had restaurants, so many places were shut down at that point in time. They had to try to figure a way to stimulate the economy. And so now what we're doing is we're realizing it's kind of that situation where, you remember that little thing when we were kids where you click the one and there's a bunch of the one ball and it clicks the balls. And then we have this, now we're watching the other side click on the other side, because now what's transpired after they went through the last, whatever you call the COVID, what was it, Omicron, back in November, when they're like, oh my gosh, we've got a whole nother variant. Is this going to do a whole nother thing? And they come to realize, okay, it's not nearly as bad. And it got to that point where it's beyond public conscious. It's just part of our new normal. The thing that started to come into play is inflation.
Yeah.
And because interest rates were so low, because there was so much money available and they had printed so much money, now the roosters have come home to roost. And they've come to realize that, oh my gosh, our inflation is so much higher than what original projections were going to be. And so they've got to stymie it in some way, shape, or form. And that's what the Fed is trying to do at this stage of the game. Now,
that's basically that sharp drop we see in 2020, correct, on this graphic, and all the way through early 2022, when almost like overnight, everything started to go back up, and in 2022. And so that's kind of the thing we're seeing. And you can see also, if you look back to 2008, at the far left side of that graphic, that's the last time we had a recession, which was at that point in time was kind of a mortgage and real estate created recession.
Absolutely.
But you notice that one, I mean, it came down quickly, but not as dramatic. And so anyway,
Absolutely.
so are we kind of like on the path back to return to normalcy? Is that what you would kind of say?
Well, so you have an action, you're going to have a subsequent reaction to it, right? So if you go back to that graph just real quickly, you can take a look in 2022. What we've done is we've had a small adjustment, a larger adjustment, and now the biggest adjustment so far. So we've had 3 Fed adjustments at this stage of the game, this one being the biggest one. And it really kind of depends on how the market accepts that Fed adjustment, which will lead into that, some further conversations in regards to interest rates on mortgages. But we need to see how the economy deals with this most recent adjustment before we have much of a clue. Are we getting back to normalcy? Okay. That's going to be the key. How is the economy going to handle things? You hear people screaming about gas. You hear people screaming about the cost of just basics, the eggs and milk at the grocery store. This will be that piece of the puzzle of what's going to happen next. Because if you see people start to pull back at this stage of the game, we could start to see some normalcy. And I think that's, as you've been saying in the real estate market, we're starting to see some reality come back to pricing.
Right. So with that said, and you said we kind of circle back to this, whenever there is a Fed rate hike, normally we hear from mortgage lenders, the Fed rate doesn't necessarily affect the mortgage interest rates, and it's not quite the same, but yet ultimately rates do kind of follow, they trail. Is that a better way to kind of explain it? Why is that?
It's a concept of spurious correlation, but I mean, it's the same thing as saying ice cream sales will increase in ice cream sales. You'll see an increase in street violence. Both of them are correlated with the fact that heat, as it gets warmer outside, more people are outside, more people want to eat ice cream, and you got more people outside, they get frustrated, they start picking fights with each other. Yeah. So it's not an exact spurious correlation, but let's just real quickly. So you have the Fed do a motion like what they did. You're going to have the stock market's reaction. The bond market is typically going to react in an opposite reactive stance than what the stock market does. And that's where interest rates on mortgages are tied to. And I'm not talking about student loans, car loans, or personal loans at banks. I'm talking about mortgage interest rates are tied to the bond market. And it really depends on how that stock market and then subsequently the bond market reacts. And that's what's going to transpire. But yes, we are now in the world where interest rates are going to be probably closer to 6% for for the foreseeable future. And I'm talking about 30-year fixed conventional loans right now.
Right.
But yeah, now's the time to see how the general populace is going to handle that when we've been spoiled with those very, very low interest rates, especially the stuff since 2021, when the Fed just bought down the rates like they did.
We're going to talk a minute about mortgage rates and purchase power, but I got a couple of questions before that. Number one is, as a mortgage lender, have you noticed in the recent weeks a slowdown in applications for new mortgages? We're seeing that happen in real estate where the business is starting to slow down a little bit. But yet properly priced homes we see come on the market are still selling within a day or two, and sometimes within a few hours. I think what we're seeing on the real estate side is fewer multiple offers, or at the very least, fewer offers above and beyond the list price. So maybe there isn't that big fight for the house. Are you seeing something similar in the mortgage side?
Yeah, I actually, so you got the micro and you got the macro. And on the macro level, I think mortgage applications are on a 22-year low at this stage of the game. And that's not me, even though I've been in the mortgage industry about that long. I've been in the mortgage industry for 23 years, just getting in back in 1999 when we were going from 8% to 7%, and people were like dancing a jig.
Yeah.
So now we're in a situation where we're seeing that significant increase over the course of the last 3 months. Yeah, you're going to see a slowdown. I remember the conversation I had with the couple in November, and they were qualified for 420, and then are reaching out in March, and they said, "Hey, could we do 450?" And I'm like, "You're probably closer to 4 now." And they're like, "Well, shoot, we just won't buy." So you have that group of people. You have other individuals are going to be like, "Okay, let's drop down our budgetary numbers," which you're going to get into here in just a minute. But yeah, there's some people that are just opting to wait at this stage of the game.
Yeah. So if you were to pull out your crystal ball, you've kind of explained the next 30 days or next short period of time here, but 6 months out, let's say this fall, are you brave enough or crazy enough to even tackle that particular question? And if you're not, that's fine, because I'm not sure I want to answer that question myself.
So yes, it is a bravery question, because every time anybody's ever asked me this in 23 years, I remember I was sitting there watching the Gulf War where we were getting ready to go to Iraq. I thought for sure interest rates were going to drop like something fierce, and they actually went up. I'm like, you got to be kidding me. Every single thing that I thought was correct was wrong. Yeah. So my guess is we're probably looking at 6% or around that 6% range for a while. The big question, I go back to the initial point when we were talking about the Fed Reserve, we need to see how the average American citizen handles this interest rate Fed hike, this last one to see. I think we're going to stay around that 6%. But as you and I talked about probably about a month ago, is it unlikely to see 7%? If we can't get inflation under control, then yeah, it is very possible the Fed could try to make another move. At that point in time, I will tell you, my concern is that the Fed adjustments aren't doing it, and we need to look at other things. I've had you've heard me talk about this. I think ultimately, as opposed to having new programs for buyers, having new programs, new things to offset that stuff, I think it really comes down to we need to start invigorating our population by coming up with new ways to make less expensive housing.
Correct. I agree with that wholeheartedly, because prices have gone up dramatically, and I really don't see that we're going to see double-digit increase in values in 2022. Yeah. I think we're going to see probably single digits, but still more than what we have. It's kind of like the adage of, the market is going on at 100 miles an hour, and just because you take your foot off the gas pedal doesn't mean that we stop. It's still going 98 miles an hour. It's going to just slow down just slightly. So
momentum. Yeah. Exactly.
One more graphic here I have, and this graphic is one that I've kind of talked about on my show here the last month or so, and it's basically taking into account a scenario. And this is I decided on $1,200 per month for a mortgage payment. This is principal and interest only, because in January the $1,200 mortgage payment of $1,200 kind of fit in closely with what the typical mortgage or the typical sale price was at that time of the mortgage was about $276 with a sale price of around $280 to $290, assuming you got a little bit of down payment. Mm-hmm. At 3.22%, which was kind of the national average there in January, that gave you $276,000, almost $277,000 of buying power. And of course, with this phenomenal raise of interest rates as of just this past week, the national average is just almost 5.25%, which at that same $1,200 payment will only let you have a mortgage of about 217. So that's close to a $60,000 difference there. And I'm not going to say it could get worse, because it could, but I guess the point I'm trying to make, and I know you've talked about this briefly a minute ago, is there's still opportunities out there. And we talked about this before the show. There are buyers that some are going to come out of the market just because of this. But I feel like there's going to be a lot of buyers that are necessarily going to come into the market that maybe have the equity in their current home, the down payment ability, that have been sitting on the sideline, and decide that now's the time, even at 5.25, because if they're in it for long term, they know that if rates go back down, they can likely refinance, and or maybe they just stay with that rate, because if that's the going rate, that's what it is. So any comments to this at all?
Yeah. So again, this alluded to the folks I talked to in November who wanted instead of 425, and then come March, they want to be closer to 450. And I said, you're probably closer to 400 because their buying power went down. A couple things to be mindful of is, as this happens, you will have some of those people step out of the equation. They're going to go onto the sidelines. You're still going to have certain buyers, like you said, you're still getting the houses sold. You just don't have as many multiple offer scenarios. And what that does is going to lower the likelihood of the offers above asking price, and just those asinine $25,000, $35,000, $50,000 above asking price scenarios, which you're literally throwing your money out the window at that stage of the game, because the price point was less than that, the value of the house was less than that. So now, if you're one of those individuals that had that money, that equity, now you have the ability to utilize that for an actual down payment, because that didn't count as your down. That was additional money on top of the down payment just to get to that purchase price. Right. In those weird scenarios where they're going above the purchase or the actual value, now you could utilize it for down payment and lower that monthly payments. So that's a huge benefit for people that are thinking logically, thinking strategically. Fact of the matter is, yesterday was yesterday, today's today. It's a new chessboard. It's a new game. You got to play with the strategy of today's game, not the strategy of yesterday's game. And I think those with the cash on hand to do that are going to reap the rewards, because they'll see that they don't have nearly as many people competing against them.
Yeah, absolutely. Well, you've kind of answered all my questions I threw at you, even some that we didn't get to, because you kind of answered them in the way, and that's great. I want to thank you for joining me today, David. Here's where where they can find you on the website there. What's the best phone number for them to reach you at?
Cell phone's always with me. So is that mobile phone, 515-205-3962. The number again, 515-205-3962.
Well, very good. And hey, just a reminder, thanks again, David, for joining me. And just a reminder, the graphics from this week's show will be at DesMoinesMarketValues.com, along with some additional graphics that maybe we didn't show on the show this week. For example, we broke through the 2,100 listing count barrier earlier this past week, and we also surpassed 7,000 closed sales year to date. So we're right on track kind of to do a similar closed sales for last year, although I think we're going to see some changes coming on that. And so lastly, of course, don't forget to subscribe to this YouTube channel. Hit the bell icon. So no pun intended there, David. Hit the bell icon so that you'll be notified instantly when any new show or breaking news appears. So again, David, thank you for joining me, and we'll talk to you all, guys. We'll talk to you all again next week, and be safe out there and have a great week.